This evening, we're going to look at drafting and interpreting financial statements. So hopefully that's why you're here. And we're going to look at tasks 1 and 2. So you get a bonus task this evening because tasks 1 and 2 are it's just one long task, just split over 2. And it's worth an awful lot of marks. So you need to be really, really comfortable with it. Now, you could get statement of financial position, you could get statement of profit loss. Students tend to like those sort of things. We're quite familiar with what we call a P&L and balance sheet in old terms, but you could get them and students tend to like them. What you could also get is a statement of cash flows. Students tend not to like statement of cash flows. Has anyone else got any thoughts about statement of cash flows? Do you like them? Do you not? Because it's one of the things that it might not come up. And you won't get it in your exam, but it might be the case that it does come up. And if it does come up and you don't know how to do them, you're in a world of trouble. It's not one of those small things that it comes up, it'll only be worth a couple of marks and it's not going to make or break with your exam. If statement of cash flows comes up and you don't know how to do them, you are in a bad place. So you need to be comfortable with that. But before we go in and get back into a couple of things you need to bear in mind. The own figure rule is your friend. Do not give up on these types of questions. Yes, you might make an error, but there's still lots of marks you can get by using your own figures correctly. Say you make an error with, I don't know, the tax paid. It's wrong, you lose a mark or half a mark or something. But if you carry on and use your incorrect figure correctly, you'll still get the marks. And the other thing I would say is, when you're doing your revision and you do a statement of cash flows, if it doesn't balance at the bottom, don't be concerned that it's all wrong and you're going to fail. That one at the bottom, if it balances, that's a nice bonus, but it's not the be all and end all. I mean, you can have 95% of the marks here and you've made an error and it will not balance. That's fine. But getting 95% of the marks available is huge because there's loads of marks available for it. So please don't panic about that. So what we're going to do is go work through a statement of cash flow. We're going to take it nice and slow, step by step. And hopefully you should see it's nice and straightforward, mostly. Right, let's share my screen then and get started. Can you see my screen? You should be able to see where it says task 1 and 2. Here's an example task to practice. Is that what you can see? Brilliant. Right. So it's task 1 and 2. It's a big one. It is what it is. You've got to do it. So we've opened up our exam. It's a statement of cash flow. Hopefully you're thinking, that's easy. I like them. And not, oh, I wish I'd practiced these more. So this is the first thing you'll see in your exam. We've got a statement of cash flow. And they have to give you a statement of financial position and a statement of profit and loss. You can't do the questions without them. So these questions are very, very standardized. So don't get creative and put all manner of weird stuff in here. It's the same thing time and time again. So you do loads and loads of practice, you'll know exactly what sort of things are going to come up. So we've got statement of cash flow, statement of profit and loss, and you'll always have additional information because it makes life interesting. There'll always be additional information, and it's the usual sort of things. We've got some depreciation. There's always depreciation. There's an asset that's been disposed of. There's always an asset that comes or goes or something like that. Always be there. All expenses are paid in cash and purchases are made on credit terms. That's always the standard case. And there's a dividend. Typical things you'll see time and time again with a statement of cash flow question. Then we've got our first thing we need to do is our reconciliation of profit before tax to net cash from operating activities. A bit of a mouthful, but basically what we're trying to do is start with our profit before tax, our accounting profit before tax, to come to what is effectively what was the actual cash effect from what we did during the year. So we're adjusting for non-cash items and adjusting for things that we've perhaps paid but not had the expense for, or things that we've had the expense for but not yet paid, and just bringing the profit in line with the cash figure. Has anyone got any questions on this before we get cracking? And I do apologize in advance. There's going to be a lot of scrolling up and down. So the first thing we do is start with profit before tax. You might see some old questions where we start with profit from operations. They're old, they're out of date. We don't do that. So if you look for stuff on YouTube and the internet, you can find anything on the internet. If you fit the old questions where you start with profit operations, they're wrong, they're out of date. They were the one AQ 2016 first came in. All Q22 drafting interpreted financial statements of cash flows will start with profit before tax. So I've got to scroll up and we start with our profit before tax, which is this figure here. We don't start with the total comprehensive income for the year. We start with the profit before tax. So that's 319. 319. Then we've got to run our adjustments for non-cash items. So the first one, it's always there. I will guarantee it will always be there. First one is depreciation. You have to write it out, you'll get drop-down boxes, but the first one is depreciation. The depreciation is 1,242,000. Remember, we are working in thousands. These are marked by computers. Make sure you give your answer in the right format. So depreciation, are we going to add that on or take that off our profit before tax? You've got a 50-50 chance. So feel free to have a go. Are we going to add it on or take it off? I mean, what we're trying to achieve here, we want to try and bring our profit in line with our cash for the year. Now, depreciation is an expense, but it's only a provision we've put in for the falling value of our assets. So it's reduced our profit, but we've not paid anything out. So it's reduced our profit, but it hasn't reduced our cash. So what do we need to do to our profit to bring it back in line with our cash, which is increase it? We need to add it back on, because previously we took the depreciation off the profit, but it didn't reduce our cash. So we need to add it back on to bring our profit back in line with our cash. Does everyone see why we're adding this back on? We've already reduced our profit because of it, but it didn't touch our cash. So we need to bring it back up to our cash figure. What we're doing is adjusting our profit figure to our cash. What did we actually receive and pay out with cash? So the depreciation reduces profit, it doesn't reduce cash. So if we need to bring our profit back in line, we need to add it back on. So anything is a non-cash item that reduce profit, we add it back on. Which brings us to the next one, which I know we've got here. I'll put it in to save scrolling up and down, but a disposal. Cool. So we've got property and plant and equipment. It costs £5 million, accumulated depreciation of 3,250,000, and there was a loss on disposal amounting to £812,000. So it is a loss, and given what we've said about depreciation, what do we need to do to this loss to bring our profit figure back in line with our cash? Do we need to add it on or take it off? Now think about what happened. Would a loss on disposal reduce or increase our profit for the year? And it's the same principle as our depreciation. That's right. So if a loss on disposal would reduce our profit, so if we've reduced our profit for this loss, but it's not a cash loss, it's just an accounting loss in terms of it went for less than what we thought it was worth. Later on, we'll worry about what we got for it. But in terms of an accounting loss, it's reduced our profit, it hasn't reduced our cash. So we're going to add this back on. Likewise, if we'd made a loss on disposal, so if we made a profit on disposal, it would have increased our accounting profit, but not the cash. So we would need to take off a profit, where this is a loss. So we need to increase it back up. So that's disposal, and that was a loss. So the next thing we need to look at is the finance costs. Now, the finance costs, sometimes we'll need to do a working on this because sometimes it might be accrued interest, say. And so what we're interested in is not what was our finance cost for the year. Our finance cost for the year was 40,000 in this case. What we're looking for is what did we pay out in interest? Now, there's no adjustment made to interest, so we can be confident that what we have as a charge is what we paid out, but we might need to do an adjustment. So in this case, finance is 40. Now, that needs to be added on to our profit. Because we took it from profit before tax, it's previously reduced it. So we're going to add this back on and we'll deal with it later on. So the bit we add on is the charge, because that's what it is. And then we're going to have to do an adjustment, but there is no adjustment to be made. So we're just going to take it off again. So finance charge comes off here. So does everyone see what we're doing here? We're adding back on the charge because it has reduced our profit. We need to bring it back in line, but then we take it off again later. But here we've taken off the same figure because there's no adjustment. But what we would take off here is the finance charge that we physically paid out. But we haven't got any adjustment to be made. So there's no account for accruals and prepayments. We might have to do that with tax though later on. So we've dealt with the finance charge. So the next one's the ones you will always have to do. And these come from the statement of financial position. So we go down here. So it's our inventories, receivables, and payables. So the first thing I always like to do very clear is get it clear in your mind with the statement of financial position, which year is which. Don't always assume it's 2005 and 2006. It's going to be 2006, 2005. So 2006 is on the left, 2005 is on the right. So let's look at inventories first. Inventories have gone up. If our inventories have gone up, will that reduce or increase the amount of cash we had available during the year? If our inventories are greater at the end of the year than what they are at the start of the year, will that free up cash or tie up cash? That's right, it would reduce cash. So obviously, the more inventory we've got, the more inventory we paid for. So if inventory goes up, cash must go down. So inventories have gone from 163 to 189. So they've gone up by 26. So apologies for this scrolling on this one. So you've got the change in inventories. And they've got difference of 26. This would reduce cash because we've got more cash tied up in inventories than sat in the bank. So the next one, receivables. So receivables are 2,500 at the end of the year, but with 2,201 at the beginning of the year. Would that increase or decrease cash? Again, exactly right. So if people owe us money, that's a good thing. We like people owing us money, but it means if they owe us money, they haven't given us money. So actually at the end of the year, we're owed £299,000 more than we were at the beginning, which means of the sales we've made, that appears in our profit figure, we haven't actually received £299,000 of it. So that will have reduced cash. Does everyone see that? Receivables. And then the last one is payables. So payables are down here. So payables were 1,112,000. At the end of the year, there were only £850,000. So we owe less. Would that increase or decrease cash? You've got a 50-50 chance. You're right again, it would decrease cash. Obviously, from a balance sheet point of view, owing people money or owing people less money is good. You've got less liabilities. But how do you get rid of liabilities? You pay them off. So over the course of the year, we must have paid off £262,000 more than purchases we've taken out during the year. So from a cash point of view, we are £262,000 worse off because of our payables. So sometimes you see, debts going up, you think that's not a good thing. But from a cash point of view, it's a good thing because the money's in your bank account and not theirs. So is everyone okay with those three adjustments you will always have to make? And inventory receivables going up ties up cash, payables going up frees up cash, and vice versa. So that's so far. Now, the finance charge mentioned, we've got no adjustment in here, but if we did, we'd have to do a T account to work out what we actually paid in interest, taking account an opening accrual or a closing accrual. We haven't got that. So the finance charge is what we actually paid out. But what we do have is an issue with regards tax. So at the beginning of the year, we'd owed £18,000. At the end of the year, we owed £20,000. So remember, for a limited company, you pay the tax after the year end. So at the end of the year, we think we owe £20,000. At the beginning of the year, we owed 18. So in theory, if we think we owe 20, the tax charge for this year would be 20, but it's not. It's actually 22. So we've got to make an adjustment. So let's see what we've done here. So we've got to do our working. So we've got our tax liability. Moment from a pen to catch up, liability. And at the beginning of the year, we owed £18,000. Then this year, our tax charge, taken from our statement of profit and loss, was £22,000. So what we want to do is work out what did we actually pay in tax. So if at the beginning of the year we'd owed 18, we got, I don't know why I'm doing a calculator, I can do it from head. At the beginning of the year we had owed 18. We then bring a tax charge in of 22, meaning at that point there we owe 40. But if at the end of the year, a closing liability, we only owed 20, what must we have paid during the year? That's right. So we must have paid 20 during the year, which presumably means there was an under provision from the previous year. So the previous year we said we owe 18. HMRC come and looked through our books and went, no, you don't. You owe us actually 20. So we paid 18 that was in the provision. We paid 2 for the under provision, which means our tax charge is now 2 for this year, which relates to this. And then this year we did our tax return. We think we owe 20. So our closing balance, but our figure in the P&L would be the £20,000 we think we owe from this year, plus the £2,000 that we had an under provision for the year before. Is everyone okay with that, or do you want me to go over that again? Brings us 20. So we can work through these. We've got 319 plus the 1242 plus 812 plus 40 plus, no, minus 26 minus 299 minus 262 minus 40 minus 20 is a figure of 1766. So that is the cash we've generated from our day-to-day transactions, our operating activities. But there will be some other things that will affect our cash position during the year that relate to non-day-to-day transactions. So, and well, obviously it's the sale, purchase of assets and financing things. So let's move on. Again, apologies, with lots of scrolling because we're going up and down. So now we're going to finish off the statement of cash flows for the year end. I'm going to put this in before I forget. It was 1766. So put that in. That'll be like half mark for following from the previous year. Now we're going to look at investing activities, which basically means, did we sell any assets? Did we buy any assets? So we've got some workings down here. So at the plant and equipment, and you'll always get this, you'll have opening plant and equipment and you'll have some closing plant and equipment. Obviously, they will be different figures. And I almost guarantee you it will not be because we've depreciated the assets and that's it. There'll be depreciation and an asset will be bought or disposed of, or perhaps both, and you've got to work out how much. So we're going to use our figures from the statement of financial position and work out. Right, so we've got to go to a statement of financial position. So at the end of the year, we had 1560. I'm going to write that down before I forget. And at the beginning of the year, we have 1,243.43. So our assets have gone up. You can see that net book value. So we must have bought some assets during the year. Does everyone see that? So I'm going to put these figures in before I forget. So we had opening, PPE, which taken on different meaning since it was 1, 2, 4, 2, 3, and you got closing. PPE, and this, so at the end we had 1560 or 15,600, I should say. So our assets at the beginning of the year were 12,423,000. So one thing that's going to reduce our assets would be depreciation. And that was, right from the next one, 1,242,000. So that's going to come off that figure. Then, if we remember rightly, we had a loss on disposal. So we had a disposal. That is going to reduce our plant and the net book value of our plant and equipment. So what we want to do here is take up the net book value of the plant equipment that has been disposed of. We don't care at this point in time where we made a profit and loss on it. We don't care what we got for it. All we're looking at is the net book value, because that will reduce our opening plant and equipment net book value. And then the difference between what we had and what we got at the end of the year must be what we bought. So all we care about is the net book value in here. So I'll leave this with you, but here we've got equipment of 5 million, accumulated depreciation of 3,250,000, and we made a loss of £812,000. What is the net book value of the PPE? Well, I don't know why that came out of my calculator, but that's definitely not it. Anyone? So it had cost of £5 million. And we have accumulated depreciation of £3,250,000. It would have a net book value of £1,750,000. The loss that it's disposed of is irrelevant to calculating the net book value with the information we've got. All we're interested in is the net book value of that asset. So 1,750,000. Can everyone see where that came from? So if we take our assets at the beginning of the year, we had £12,423,000 worth of assets. We then depreciated them by £1,242,000. So now they're worth £11,181,000. We then sold £1,750,000 of those assets. So at that point there, we had assets worth £9,431,000. So that's the assets, the existing assets, that's what they're worth before any additions. So if we've got £15,600,000 at the year end, we must have bought £6,169,000 worth of assets. Does everyone see where that came from? We started with what we had at the beginning. We then reduced it for depreciation. We then reduced it for the ones that sold. And so if that's what we had from the existing assets, and that's what we've got at the year end, the difference has to be what we bought. Does everyone see that? Cool. So whilst we're dealing with this asset, let's move on. I think that it is the next one. So what we want is the proceeds on disposal of plant and equipment. So when we talk about investing activities, all we think about is cash. All we're interested in is cash. We don't care if we made a profit and loss or anything. Not to do it. Basically, what cash went out in purchasing assets, what cash came in when selling assets. So if we had net book value of, we've already worked it out, haven't we? £1,750,000. And if we made a loss, how much was it? 812, wasn't it? So if a net book value was 1,750,000, and we made a loss of £812,000, how much money did we receive for the asset that we got, i.e. the proceeds? Because that's all we're interested in. We don't care whether it was a profit or loss or anything like that. It's literally, what did we receive in the way of cash? We had a loss of 812. So if we've got a loss, did we receive more or less than we held it at? Yeah, you're exactly right. So if we had a loss on it, we must have sold it for, was it £812,000 less than it was held in the accounts for. So 1,750,000 minus 812 gives, so we must have received £938,000 for it. That's all we're interested in. What cash did we receive? Does everyone see A, why we're doing it, and B, where that came from? So then we can start filling in our statement of cash flows. So you've got purchase, PPE, and then you've got, I can't find the right, anyway, disposal of PPE. So the disposal, we sold it. We've got some money. So that must be an inflow of £938,000. So the next one is our purchase, which obviously has got to be an outflow. So that was 6169. And that is an outflow. And it's very important to show whether it is positive or it was negative in these things. It makes a world of difference. So our net cash from investing activities, 6169 minus 938, it gives us net cash outflow for investment activities of £5,231,000. It's got to be negative. So the last bit we're looking for is financing activities. So with financing activities, we're looking at where does the long-term investment for the business come from? And it comes from a couple of things. Shares, and it comes from, well, obviously shares raise capital, but also with shares, you've normally got to pay them a dividend. And remember, dividends are not allowable for tax, so don't appear in our statement of profit and loss. So we'll need to adjust for that. And then the other bit we might raise money from is from the bank. Sometimes we take a bank loan out, sometimes we pay it off. So let's see what we have got. And these will all be taken from the statement of financial position. So you can see here, our share capital has gone from £10 million to £11 million. So how much cash must have we received in total from the share issue? This is a trick question, by the way. So whilst our issued share capital has gone up by £1 million, how much money must we have physically received? Like I said, this is a trick question. Because when you issue like a £1 share, do we sell it for £1 normally? Normally, we sell it for over and above what the face value of the share is. So I did catch a few people out. So the share capital has gone up £1 million, but the share premium has also gone up. So remember, the share premium is what people pay over and above the face value of the shares. So here, the company must have issued 1 million £1 shares, or 2 million 50p shares, but let's not complicate matters. Let's say we issued 1 million £1 shares. They did not sell them for £1 million. Their share premium has also gone up. So how much must they have raised from this share issue? Again, this is the sort of thing it'll be highly likely in the question. So we've raised £1 million here. So our share capital has gone from £1 million, but our share premium has gone up £3 million. So what we must have done is issued 1 million £1 shares, but sold them for £4 each. So for every £1 share, we sold it for £4. So for every £4, £1 is share capital, £3 is share premium. Does everyone follow that? So we issued 1 million shares, and on paper it says it's a £1 share. But remember, as companies go up, we don't change the market value of the shares. Is not the share price; it's still a £1 share. But people pay more for it because it's worth the company grows. So for every share, we sold it for £4. But £1 goes to share capital, £3 goes to share premium. So there's 1 million more shares, or £1 million worth more of shares in circulation, but people paid £4 million for it. So the share issue raised the company £4 million. Cool. So I'm not going to scroll back down to scroll back up. Let's save the time. So we know our share issue raised us £4 million. But the next bit I mentioned is companies can raise money from loans. So you can see here at the beginning of the year, our loans, long-term loans, were £1 million. At the end of the year, they were £800,000. So have we increased or decreased our cash because of our investing activity or financing activities? That's right. So over the course of the year, the amount of money that we owe has fallen by £200,000. We must have paid off £200,000 worth of our loans. So obviously it's a capital repayment. It doesn't appear in statement of financial position. The interest on that loan we've already dealt with. So it's just how much did we pay off in terms of capital? Well, in this case, must be £200,000. So that's going to reduce our cash. Now, you might get a question where the actual loan at the end of the year is greater than what we had at the beginning of the year. So in that scenario, they must have taken out additional funding. So that will increase cash, but that's not what's happened here. We've just paid some more off. So actually, it will reduce our cash by 200,000. And the last little bit is our dividend of 100. See how good my memory is. Dividends don't appear in the statement of financial position. They are not allowable for tax. Sorry, they don't appear in the statement of profit and loss. They're not allowable for tax. We've not dealt with this as yet. So we then put our, find it, financing activities together. So we've got our share issue. So that will be a positive £4 million because money came into the business. Then we had the loan repayment. And that was £200,000 negative for cash. And then the last one is dividend, which was £100,000 worth of dividends, negative because it's cash going out of the business. Means our net financing, I should be able to do in my head, is 3,700,000 negative. Does everyone follow where those figures came from? I've run out of copy. Yeah. So what we need to do now is just finish it off, cross our fingers, and hope that it all adds up. And if it doesn't add up, it's not the end of the world. You'll still get loads and loads of marks. But if it does balance off, you can be relatively confident you've got all the marks. So we have positive £1,766,000 from our operating activities. Take off the $5,231,000 from our, that should be positive because the shares coming in were greater than the ones going out. Take off the $5,231,000 that we spent net on buying and selling assets, plus the $3,700,000 that we got from the issuing the shares, but after we paid a bit of loan off and dividend, gives us £235,000 positive net cash flow. So the last little bit is putting our cash and cash equivalents for the year. Now these are taken straight from the financial position. Whatever you do, do not change these to try and get it to balance. Put them in. You'll get half marks probably for putting them in. And if it proves that you've made an error, doesn't matter. Do not tweak these to try and get it to balance. Because obviously you've got an error. You've lost a mark. If you tweak these, you're going to lose another mark. Put them in. And it doesn't matter if it doesn't balance. So remember, with cash and cash equivalents, we're looking for cash and cash equivalents, but also there might be an overdraft. So watch out for that. So it might be a case we've got some money in a short-term bank account, but we also have an overdraft. So look to your current liabilities as well to see if there's an overdraft, in which case here we haven't got. So our cash and cash equivalents were 423 at the beginning of the year. There was 653 at the end of the year. Let's see if we can remember that. 423, 658. 423, 658. So 423, 658. So take that, 658 minus 423 gives us a difference of £235,000. We've done it. Now, like I say, if it doesn't balance off there, don't panic and think you're going to fail the exam. Don't let it get you into fluster because you've got 5 more tasks after this. You could have 95% of all the marks, which is cracking work on a big question. But it's nice if it does balance. But don't worry if it doesn't. It's not the end of the world. What did everyone think to that so far? Because that's task 1. Do you think doable in part, in total, or not at all? Now, it could be this never comes up and you never have to do a statement of cash flow. But if it does, you are in a world of trouble. If you cannot have a go at this, you are in a world of trouble. You need to do your best. It's a very good chance it will come up. So you cannot think, it will never come up, because it does. So if you get one of these, obviously that's quite a lot of work. It's going to take you a lot of time. When you get one of these, the next task you will get, task 2, is going to be quite short. So it probably is going to be a statement of changes in equity. It might be something very small. You won't get a massive statement of cash flow and a massive statement of financial position. It just won't happen. You won't get the marks. So the last little bit is a statement of change in equity. Just stick the numbers in. Don't go changing things or anything like that. Just stick your numbers in. So we're going to put in our statement of change in equity. We've got share capital, share premium, retained earnings, and just total. Now, my memory is not so great. Let's scroll back up. So we need our opening balances, share capital, share premium, and retained earnings. Now, if between us we can remember it, that would be fantastic. So these are all going to come from the statement of financial position. So we have 10 million, 2 million, and 1,080,000. Let's see if we can do that. Get these in. You'll get marks for these, and it's literally putting these in. So retained earnings was 1,080,000. Share premium was 2, wasn't it? And that was 10 million. Then total comprehensive income. Don't fiddle this, just stick it in. So total comprehensive income was, if you can find it, £297,000. Just stick it in. So that's going to increase our retained earnings. The other thing you should say is always fill in the total column. You'll get marks for that. Again, it's just adding numbers up. 1080 plus 2 million plus 10 million. You go 13,080. So the next one we're going to have to deal with, what else is going to change? Share capital, share premium. So we've got the share issue. Let's see if we can remember. So our share capital, remember, that only went up. Remember, we saw it was a £1 share, we sold for £4, and we sold 1 million of them. So the cost of the share issue, the share capital will have gone up £1 million. The share premium will have gone up £3 million, and that will obviously come across to 4 million. And the last bit was dividends. Now, dividends will reduce our retained earnings. Dividends are paid out retained earnings. If you haven't got retained earnings, you can't pay a dividend. That's an illegal dividend. So that will reduce it to be £100. Again, put that in your total column. And then add these up. If you made an error, you'll still get marks for adding this up. So let's do most of this in my head. So that's £11 million. That's going to be £5 million. And then retained earnings, 1080 plus 297 minus 100. Now, these should be the figures that you've seen in your statement of financial position, 1277, and add it all up, plus 5, 123. No, 1277 plus 5, 123, plus £1 million. Gives a figure of 17,277. Yeah. So you can see with these questions, if you get a tricky task 1, task 2 is going to be easier because these questions are linked. It's not a case if you draw down a load of task 1s and you get a whole load of task 2s, they are intrinsically linked. So the marks are spread over both task 1 and 2. What do you think of the statement of change with equity? Do you think that's relatively doable? The thing with that is just give it time, make sure you get time for it, because there's lots of marks for just taking numbers from the statement of financial position and stick them in, really. Cool. Any questions on anything whilst I'm still here?